Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today is, well, by gosh, it is Michael Becker. Michael, how are you?
Hey, Paul, doing well. Holed up in my house. I think at the onset of week 6 of self-quarantine here.
42 days in my book, my friend. 42 days. I'm working on my second and third chin after after my wife has made sure that Amazon and the grocery store knows exactly how much food we need to ship over to our house, so we don't ever have to make a visit to a grocery store in the future. So I can't believe how big our closets are stocked with toilet paper and food and all kinds of stuff. So we are camped down, and we're coming to you at this period of time towards the 17th, 18th of April. So we're just going through interesting times. I would think that at one of these days we're going to get opened up. What are you hearing, Michael, about the economy, or at least the state of Texas opening up?
Yeah, I mean, it seems like we're going to start turning loose people maybe that first week of May. It seems like schools are canceled, or at least in-person schools are canceled the rest of the year. In Texas, we're going to be homeschooling for longer, and I've never been more appreciative of my kids' teachers than I have been here recently. But it seems like they'll start turning it back on with a small trickle, at least in Texas, probably that first part of May. And I'm sure each area will be slightly different the way they roll it out. I know there's some headlines yesterday about that kind of being turned on. So just try to be timely, because things are changing so quickly. Being that we're the 17th of April as we record this podcast. So hopefully soon, we've been communicating on a regular basis. Collections that we all feared for April would be a complete dumpster fire. Actually, it turned out to be pretty good. We'll be generally in line with normal, maybe instead of our typical delinquencies, typically say 1% or less. Across the portfolio, less than 1% will probably end in the 3 to 4% delinquent. So, it's 300 times, 400 times normal, or percent higher than normal. But, all things being equal, I think every owner I talk to is taking that as a win. So, looking forward to kind of get this thing back out and go out to eat and go to my favorite local bar and kind of get a little back to normal here.
Well, let's talk a little bit more about real estate, and let's go with the bigger picture these days. So we're excited to have one of our friends on the podcast that we've known for a long period of time, that I think you may have met him on a television show a couple of years ago, and he and his partner and I guess another family member have really done great in real estate. And I want to kind of focus on kind of the bigger picture of what's going on. And I want to get his perspective of single family. I want to understand a little bit more about multifamily, what they invest in, maybe retail, and talk a little bit about some of their schools that they have to teach some of this real estate business. So, Michael, introduce our guest, please.
Yeah, so on the podcast today, we have Paul Esajian coming live from San Diego. Paul, thanks for joining us.
Great to be here. Appreciate it.
Yeah, so most of you guys probably know Paul and his partner, Than Merrill, are probably the two people you know most. Those two guys, and I first met them virtually about 15, 16 years ago when I turned on A&E, and they were on the A&E's Flip This House in New Haven, Connecticut. So and then you've probably seen Paul, but definitely his partner, Than, on every local TV station before they come to town. They'll do a lot of promotional commercials and hear them on the radio. So Paul, welcome to the Old Capital Podcast.
It's a privilege. I love sitting in, listening, and now being on the podcast with you and Paul. Such great information week in and week out.
Yeah, maybe start with just telling us a little bit about how kind of most people maybe first got to know you guys. Talk a little bit about it's not every day we have a TV star on the podcast. So maybe you can mention a little bit how you guys got there and talk about that a little bit.
Yeah, so just to get to know me, the abridged version, me and my partners, one of my partners, Than Merrill, grew up together, but we started a real estate business in 2004, actually in New Haven, Connecticut, originally from California. We started with buying rentals and flipping houses, residential redevelopment. So 2004, we started in New Haven, Connecticut, and got going and did both rentals, again, buying single family homes, 2 families, 3 families, just like probably a lot of people excited to be in real estate and knew that's where a good amount of wealth was made and created or put. So we got really good at actually flipping properties. And at that time, there was a show, Flip This House, that was popular, looking for more locations and casts. And so in end of 2006, 2007, we started filming, and we were one of the first casts on Flip This House. So we did about 2.5 years, about 13, 14 episodes, which would be individual houses that they documented with our buy, fix, and sell, our residential redevelopment business. But since that time, our businesses are all things real estate. We love real estate. Primarily, we love learning about it and then executing on it. So that was natural for us to get into our company, which is called FortuneBuilders. So across the country and Canada, North America, we teach and train really anywhere in the world that people want to consume our education and content. We have real estate education, from online courses, live events, and then specifically coaching and self-paced learning online. So that's been a business we started in about 2 years after getting going. And then again, 2004 we started, and since then, with residential real estate, a lot of commercial real estate, and working with really smart people like Paul Peebles and Mike Becker on this call. But we're in a lot of retail. We have a great portfolio of assets there. We do own some office as well. And then just in terms of a quick resume, so people can know some of the experiences I talk from, we're in San Diego, California now. That's where we do what I call our residential redevelopment business. That's CT homes. So we flip, we buy, fix, and sell, 1 to 4 unit properties, anywhere from about 50 or so a year. And that equates to probably about $30 to $40 million of volume just in that one business, CT Home. So we're literally finding a house, we're improving the house, and we're selling it retail with an excellent rehab, and we're cranking on that. Then we also own a lot of single family rentals. So we personally own a portfolio of over 60 single family rentals across 11 states. And we, with our students, actually help them find and acquire and transact about 600 single family rental real estate units transactions a month. So we have a little bit of pulse there. And then, of course, on the commercial, like I said, we are in the commercial space. We also have the experience of a debt fund that we executed on for over 6 years and have assets internationally, Ireland. We have a portfolio of assets. So we just love real estate, and it's definitely an interesting time. There's a lot of news, a lot of unease, but there is half of a playbook, I like to say, Michael, which is, and you went through it as well. There's half of a playbook from 2008 that we get to follow here. There's just a new, very interesting wrinkle, which is the health component, and literally the whole world having to sit in one spot for a period of time. But there is a playbook here. So it's those people with a steady hand and removing a bit of emotion are going to see and benefit from as many opportunities as will be created.
Yeah, well, thanks for that. We can certainly kind of call this maybe the potpourri episode, because you certainly have a variety of experiences and investments, et cetera. And certainly like to maybe at the end talk a little bit more about kind of the education and live seminar business you guys have, maybe some of the impacts of that. But maybe we start talk a little bit. As you mentioned, you are in all or several of the various commercial real estate asset classes, as well as pretty large in the single family space. I think most people probably identify you guys with more on the single family residential, kind of the 1 to 4 space. How have you guys seen, here we are, I guess, a month and a half, 2 months into this whole process. How's the world different for you guys, or what have you seen over the last 6 to 8 weeks versus, say maybe this time a year ago? What has changed from your perspective?
Let me answer that let me put my hat on of San Diego market. We're in the single family space, and we're literally on the phones every day. That's part of our business with realtors and agents buying deals and selling deals. So, and I think San Diego, when I share this, it's a bit of a example across the country. So volume and transactions are down, certainly, from listings, new listings, and they did a few things, right? So first, the news as it came got to a point where everybody froze for a second. So there was less activity, right, of new listings and sales. There were some contracts that were falling out. So we were observing that. What was interesting is then you saw an increase of listings, and that was probably some, again, fear-based reaction to maybe people that were in their own home and maybe planning to sell it sometime in the future and got nervous and thought they should, kind of get it on now and try to sell it. And or maybe investors that were ready to kind of dump some properties. And again, or some people that were just in a financial position where they were thinking they weren't going to be able to hold some of these. But then that came down. So a little spike in listings, which we think is correlated to a little bit of emotional reaction. Then that came down. And so what we're seeing is a little bit of a new normal of transactions happening on good properties. So immediately in our market, we're on top of every property. So we saw properties falling out of contract that we were bidding on previously. And what happened was they'd fall out of contract. I'm talking about the last 3 weeks. And then immediately, at least in our market, they went back under contract with those buyers that, are in a better financial position or believe they are in a better financial position. So good deals didn't stay available for very long. So
and this would be relatively high in retail and predominantly La Jolla and near La Jolla.
Yeah, I should bracket that. So, we're in San Diego. So like our median price point, single family home, call it a 2,000 square foot plus or minus, can be 600,000, 800,000 is kind of the good deal, medium price point. We're seeing a lot of good velocity again in San Diego, and then you have the coastal parts of San Diego, which get more expensive pretty quickly, like La Jolla or the beach area. But we're seeing a lot of velocity in the San Diego market for that 800 to 1.1 million price range, meaning that's moving really good. I think that would be an example of it's not your workforce housing and it's not your one-off luxury buyer. It's the people that have been probably looking for a house, are in got a decent, stable financial position and or job, and now they can finally get some of the houses they wanted under contract. So I think that's that 800 to 1.1, and adjust that to your market, say just that medium price point and up a little bit, that quite honestly about a month ago was super, super competitive, right? Because cost of money, very great, a lot of good financing options and very competitive market. Now, I've been saying this, and I want to share a few things to give confidence to everybody listening, irregardless of what sector we're in. Transactions are still happening, right? Certainly some are canceling, and we've had that too. But we, for example, have a couple houses. We have 2 houses in the last 2 weeks that went under contract. One was about a $1.1 million single family home, like I said. So that was recently listed, not on the market very long, in the middle of this emotional state, but it was priced right. It was the right asset, renovated right, and it went under contract, quality buyer. You want to frame, at least in the residential space, you're looking to attract the end buyer that's that possible conforming loan and non-subprime borrower, because that's the debt that is going to transact right now. Some of the other financing options are going to slow down a little bit. Some of the bigger jumbos will take long, or the people that don't have perfect credit, that's going to be a little more nuanced. But that's what we're seeing is got a lot more velocity. And then this is just a good example where yesterday one of our properties, higher end home in La Jolla, so it's got some ocean views. It's not on the ocean, but ocean views, brand new property from our perspective, pretty much full gut. And we just put that under contract for $4.795 million, and the buyer's closing all cash, close in 15 days. So that's a bit of an outlier, but my point is, the people that are in a financial position in every real estate sector, and the ones that have been waiting on the sidelines with cash because they thought that the market was too frothy or too competitive, we're seeing those people transact.
Got it. How's your residential rental portfolio doing? You said you're in 11 states, about 60 assets across the country. How's that performing as far as like collections go so far? And maybe secondarily, you guys obviously you mentioned you sell a bunch of homes, kind of on turnkey. Has that business fallen off the cliff, or is that still pretty robust?
Yeah, great question. So right now, again, similar to, Michael, you've been sharing great current data really on a daily basis. And I think before I forget, if you're managing assets, if you have partners, if you borrow money, if you're in transactions, one of the key things to do right now is to over communicate and get information routinely to either your partners, your money lenders, your banks, so that there's a level of information transparency, and then that will equal confidence. It's when people are in the dark, they get emotional and they can create their own stories. So what we're seeing right now on the residential, meaning a single family home with a single family renter, for April, not much change. There's a couple more, obviously a couple more calls and communication of preparing for possibly the next month, if they can't get back to work, and having those conversations. But I know, for example, one of our investors was looking at their portfolio of about 20 houses. They only had one tenant so far that said, I'm not able to pay. So one of the things we like to do on a share there as well, that's a particular asset, a single family home, but really it's real estate in general. If you compare it, so now let me answer the question where we work with people, and there, again, about 600 single family homes we help people acquire throughout the course of a year. Well, there's, just like 2008, the volatility of the equity markets, the stock market, and the uncertainty there, and watching your account yo-yo up and down every day. Most people don't have the stomach for it. And I'd say this as well, even though we're all told like that's normal, it's actually, the market is actually pretty volatile. If you study it over a course of time, you just stick with it. But even with that said, people don't like that. So when we are talking right now, we're still putting single family homes under contract. The reason being is, what are you going to do with your capital? You're not going to put it in the stock market, because you're probably, the majority of us don't fit the profile where we like to, have uncertainty and have that volatile investment go up and down. And another way of saying it is, if you buy, really, I don't want to be too broad stroked here, but if you buy real estate, let's say that in a market where, we're in a cycle or values adjusting, it's kind of like saying to someone, hey, if you have a portfolio of stocks right now and it only lost, between 1% and 5% of value, and you were told that you're not going to get your dividend check for 3 months or maybe 4 or 5 months, would you be okay with that versus the current reality? And the answer would be, that'd be great, right? Well, that's a little bit of how, these real estate assets perform. So a single family home, if you study the rent in the markets, that we're in, the rent didn't go down very much at all in 2009 and 10. It dipped a little bit, call it 5%, 10%, maybe globally, but then it just, stayed steady. So it's a good spot to put money, real estate, I'm saying in general. And then again, our single family investments or buyers, the logic hasn't changed. What we do have to do though right now that is taking a little more time, which is totally fine, is actually go through the emotion all of us are having. So someone, a month ago who we were talking to is saying, I'm looking to buy, 5 single family homes. Well, then this market and this crazy news happens, and then, we're very emotional. So we have to get through the emotional part. We have to talk about that, and then go through the check boxes. Well, do you want to put money in the stock market? No. Do you want to keep it in cash and, watch it lose its value? No. Do you want to put it in a CD? Maybe. Or do you want to park it in real estate that, fundamentally will check the boxes, and possibly the value moves a little bit, but we're going to keep it steady. So that's been the experience. So again, the volume on selling those single family homes, is actually, it's maintaining, coming down just a little bit in general, because like all things, people are kind of watching and checking the news, but it's not business as usual, but it is business going on for sure.
So I know you guys are in several retail investments as well. That you guys do that in predominantly, I believe, the southeast part of the country. And I know everything obviously is very specific to the situations, but I heard a interview, I think it was around the 10th of the month, with the CEO of Related, which is a really large, diversified REIT that owns a variety of asset classes. And he mentioned that they own office, multifamily, and retail. And as of the 10th of April, I think he said that his office was about 95% collected, his multifamily was about 90% collected, and his retail was like 26% collected, or some crazy number like that. What have you guys experienced? Maybe kind of just do the real high level version of what you guys kind of own, and then what have you guys experienced so far, being halfway through April?
Yeah, so we have about 3.7 million square feet of retail in the southeast region, like you said there, with you and other partners, about 1.6 million square feet of multifamily, to about 300,000 square feet of office. And I would say that what you just shared is probably a pretty global statement that, percentages will change a little bit in individual scenarios, but that's on the multifamily. Our specific experience is April has actually been collected at a very high rate, 90 in our portfolio. So, it's just our portfolio, which is pretty large, 90%. But we absolutely are in the middle of conversations, and May will not be that. May will be a lot of people, really depending on a number of factors, deferring rent, working out rent. Do they get their PPP loan, which obviously as of yesterday, they ran out of money or said that all the money's allocated. So May, I think in May and June, you're really going to get transparency on the work that's needed with retail clients. It's going to be tough on smaller, say like the nail salon example, right? I mean, just your local operator, they don't typically run their business where they've got 2, 3, 4 months of reserve. So I do fear that some good tenants are going to not make it through, this time as we have to shutter our businesses. But then you have your creditworthy tenants. And frankly, that's just right now a bit of a negotiation game. So we're finding in some of our centers, they're certainly, again, think of the Dick's Sporting Goods, or you're reading them in the news, Ross, Marshalls, et cetera. They're, getting into the conversation to take advantage of the opportunity. Hey, we're going to defer rent, and we're not going to pay rent. But what we're doing on our end as operators of that retail is saying, okay, well, let's take this conversation as an opportunity to better the lease for the future, maybe extend terms, longer lease, get rates that we need in the future. If we do defer rent for 1, 2, or 3 months, there are some tenants that are asking for abatement. So that's, I think, the opportunity for retail operators. With the creditworthy tenants, that's the game you're going to play. But there's going to be, for sure, in May and June, more difficulty on paying rent, just because the country's, shelter in place and literally told you can't have your business open. So it'll be interesting to see what happens in May, as some activity happens in some states, but that's definitely an impact.
Have you noticed any big disparity from geographical parts of the country? Obviously, you're in many markets. Have you seen anything differ between this particular market compared to the other one? Within any markets maybe that you're in being a little more resilient or a little bit more distressed?
I personally can't say I can draw any real conclusions. We don't own anything in New York City, and that's a very extreme situation. But I really can't with certainty give some correlations there geographically. I do experience and feel, not only from our tenants, but then from, we have a very large community of investors in Fortune Builders all across the country. So we're on a daily basis in communication. We have a closed Facebook group, so I'm seeing what's going on. There is a positive kind of pent up. People want to go to work. People want to do transactions. They want to, quote, get back to normal on all sides of the coin. They just can't. So that's like the positive share. It's just, how much kind of rough damage are we all going to take as time goes by here before we can get back to a little bit of rhythm.
So you referenced this a little bit earlier. What are some of the things you guys are doing from a communication standpoint? Obviously you're in several of the deals, or we partnered and did several deals together on the multifamily side. So you seeing kind of my basically daily communication with all the investors that are in there, kind of sharing collections or occasionally some various other metrics. What are some of the things that you guys are doing from a communication standpoint, and what would you recommend that everyone does? Because obviously you referenced this a little bit earlier, that communication is going to be key to getting through this with all the various stakeholders in the deal, whether it's your residents or your lender, your investors, or your management companies. Communication is kind of probably be the lifeblood that's going to get you through this.
Yeah, I mean, we're definitely a page out of your playbook, Michael, where you just got to communicate as much as you can and be transparent and educate. Hey, here's the position we're in, and here's how we're going to protect that position. Here's what we know. Here's what we don't know. And in some cases, when you have partners or when you have deals where you have just money partners, nobody as a money partner likes the experience of getting a check and then not getting a check, but adding a little more color on how we're protecting the investment for that partner by, say, waiting to distribute or holding back distributions to make sure that our balance sheet is bolstered with cash. A little bit more of that communication in our emails and newsletters is happening right now, so that there's explanation and education. But the other thing is to then also within our community share positive news as soon as you get it too. And so I think the smart thing to do right now with your partnerships, your investors, your groups is to more regularly communicate, more regularly, we don't have all the answers because nobody does right now. So you don't say that you do if you don't, but share the things that are positive that are happening. If you get transactions, if you get deals under contract, if things are closing, that spirit helps that person's confidence and belief in what you're doing and how you're doing things. That's going to carry for a little bit. So I think the main thing is not to go dark and say, I don't have anything to say, so I'm not going to say anything at all. Communicate, share what we do know, what's in a good position, and what we're working on. That's been our process right now.
So one of the things you probably are kind of uniquely qualified to talk about, or you have definitely a different perspective, is you run a pretty large educational company where you have tens and tens of thousands of clients or students, as well as you probably touch some form of fashion, 1 million plus people a year through the various marketing efforts. Maybe you kind of talk a little bit high level about kind of where you guys were kind of for 2019, maybe some of the stats of number of seminars, et cetera, then kind of how you guys see 2020 being, different with the COVID and how that's impacting you guys. The last time we saw each other in person was in Las Vegas when you guys had a conference, and there was nearly 4,000 people in attendance with us. Something along those lines, pretty large seminar. So maybe talk a little bit about that and kind of some of the impacts that you guys are feeling right now.
Yeah, for sure. So Fortune Builders is a real estate education company. We have coaching, mentoring, online products, self-paced learning, but we do that with a lot of live events. And for example, in 2019, through a series of different live events that we run, we will run anywhere from 5,000 plus different live events through the course of a year across the country. That's a lot of live events. So, we have to joke in times like these for a little bit of levity, but there's a few things you don't want to be in the business of right now. I think flying airplanes is a tough business. That certainly got hit immediately. And then having a business model where you focus on getting people together in person, that ain't going to work either. And that was one of our main things that we did. However, our coaching, our education, and our fulfillment, and to just draw a analogy, think of any one of the universities, colleges, and they do classes online, and they have before this. Well, all of our education and our trainings and our classes on how to, invest in commercial assets, invest in multifamily, buy a single family, how to do a rehab, the 7-stage process to execute a rehab, the 6 critical documents. Those are all online trainings self-paced, and that was before COVID-19. So luckily in that situation, our education and our fulfillment, as we call it, the experience for our investors to consume and do coaching calls, that really hasn't changed. But there is one component where we, on about a monthly basis, we get together about 1,000 people every month in a different location. Hotel, we'll take over a hotel like in Las Vegas. That's our one bigger event of the year. And we'll get together and we'll run multiple events. Well, we're not able to do that. So how are we pivoting? Well, for our live events, we're doing webinars and we're doing live streams. So, for example, 2.5 weeks ago, or call it 3 weeks ago, we had an event that we could not run for a number of people. So we have a professional studio here in San Diego in our office, and we did a live stream broadcast. And there's about 1,100 people from 9 to 6. My partner, Than Merrill, taught the whole day, and different instructors like myself came in for some different parts of it. And we had a really great experience. So, people are literally like all three of us on this phone, we're told and stuck at home. So what are our options? So it's a live cast, and it was a really positive experience. And we're doing now, that's how we're pivoting. So every weekend, I should say, we're running different live events. We teach marketing, we teach acquisitions, we teach how to raise capital for your deals, we teach commercial investing. So we're doing those spread out over the next month. Every weekend, we're doing that as a live cast experience. So that's how we're able to pivot. And, a lot of you are probably now, if you haven't been, you are now experiencing Zoom, GoToWebinar. Well, we've used all that for a long time. Now we're just having to use it in place of our live event gatherings.
I think that's going to be kind of the wave of the future. And, you have a couple small kids, and I know Than does too. But I think that's the way that colleges are going to start being taught these days on these webinars versus, paying $55,000 or $75,000 a year for college tuitions. I just see that being the wave of the future. But these big meetings, I've gone to one of your meetings in Las Vegas. It's a fantastic opportunity to meet other like-minded individuals, and that you've had some great speakers up on stage. You've had the gentleman that shot and killed Osama bin Laden. You have SEC attorneys. You have a lot of people that are just interesting people to listen to, and they usually have 4,000 or 5,000 like-minded real estate folks coming together in Las Vegas once a year. Are you having the conference this year, or is it going to be kind of a virtual conference?
Yeah, great question. So again, we have we have a calendar of live events, and obviously right now we can't have them if they're today. But for example, we're planning on, and it's fluid. We're using that word a lot these days, but we're planning on having live events as soon as the proper guidance by our governments and our states rolls out, possibly as soon as July, maybe August. Now, again, it could change, but we are planning on our annual event that we do in Las Vegas, absolutely, of having that. Will it be a little bit different on the setup? For example, right before the shelter in place really across the country got implemented, we were given guidance towards the tail end before that happened to do 6-foot spacing in a conference room, in a ballroom. So that's exactly what we did. We had tables set up, and every person from front, back, left, and right was spaced 6 feet apart. And seems kind of, when I say it, maybe like it'd be obviously a little bit of a weird experience, but frankly, I was there teaching. It was fine. It was different. For sure, there's going to be a lot of different things, but I think you're going to find, as we roll back into our societies and our daily routines, obviously masks being normal, social distancing remaining for a period of time, and at live events, I think you're literally going to see that at least for a couple months coming out of this, where when you get people together, there's going to be a max number of heads allowed. That'll come from the state and then the local municipality. So if you're running events, you need to check, like if you're going to take, for example, Seattle, you're going to need to check the state of Washington, but then also the city of Seattle mandate. How many people are they at the current time allowing you to congregate? And then what's the definitions they're going to ask you to do? So 6-foot spacing. I think you're going to see that probably be a standard when we come out. And I think you're going to see caps on the number of people in a conference room, in a large gathering. And, I would totally be guessing if I put an estimate on if that was, for a month or 2 months when we come out, but I don't know. But
finishing up, I mean, you guys are in Southern California and you guys do just a great job in the educational space and buying properties in all these different states. And you guys have a little bit of a concentration in California. I looked on your website under the Equity Street Capital side, and most of the commercial buildings that you guys own are every place besides Southern California. I hate to pick on California these days, but what are you seeing from legislature of, either controlling the rents, or you still see a flight of capital leaving California to invest in other places besides California?
I think that's going to remain. I don't think that the coronavirus or this COVID-19 is going to dramatically change what we've been seeing over a number of years where, California, I love living here. It's a difficult state, and they make it difficult to be a business owner, and then owning property. There's some pluses and minuses, hence why we like to own property in Texas with all of you. So I don't think that theme, frankly, is going to change much. What it will do, this isn't specific to California, but it'll create opportunities for investors that do invest in California to make money on assets and with some depressed pricing. But I think that routine, businesses migrating to Texas, people migrate, as an example, or states that are more business friendly and less restrictive. I think you're going to see that. I don't think that's going to change. And if anything, it might encourage a few people if more rules get put in place on daily, your daily life decisions, and then from how you run a business. I think that might tick up, but I don't think that's going to be too different from the trend that's happened. But as we say, California, we have beaches and sunshine. So as people leave, there's always people that come for just that. And then we'll see how long they stay, right? As we called it, sunshine tax and all the other things you have to put up with. But
I absolutely love the Californians' money coming over to Texas or other parts of the United States. So we certainly say live in California, but invest your dollars in other parts of the country because it makes a better investment for you. At least that's what we believe. Paul, if somebody wanted to get more information about Fortune Builders and your group, what's the best and easiest way for them to get a hold of you?
Absolutely. Just, go to FortuneBuilders.com. That's our education website. We have coaching, we have mentoring, we have longer involved education and training over 6 months or 12 months, or smaller short classes to consume. But at FortuneBuilders.com, we've got a great website. You can learn about us more there and see the different offerings and education we support the investing community with. And for example, at Fortune Builders, we teach a commercial investing class, and we do that with Michael. And Michael and I sit there for 2 days and walk through literally step by step how to analyze, acquire, structure, finance, manage a multifamily property. And we're very thankful to have Michael, for example, to be one of the trainers. But that's a type of classes that you can learn more about at FortuneBuilders.com. That's
great. Michael, any ending words?
Paul, we appreciate you joining us on the podcast. We appreciate kind of a little different perspective. We always are so multifamily centric, and a lot of it's even Texas centric. So it's good to get a little different perspective from someone's got a variety of assets and some different business experience and a lot of people that we talk to. So we definitely appreciate you taking the time today to join us on the podcast.
Absolutely. Love to be a part of it. Thanks for everything you guys do. I will leave with, just a vote of confidence. Things will go back to quote normal, be a little different, but don't be emotional. Keep a steady hand. Take this time to learn and plug into podcasts like this, because there's going to be, as with any changing environment and cycle, there's going to be some great opportunities. So it's those people that stay the course are going to be benefiting from helping people and helping themselves.
That's great. So, Paul, we very much appreciate you being on. Thanks for taking some time out of your busy day in Southern California off the beach and off the ocean. That's good for you. Not so good for us being in Texas. So, Michael Becker, go for a walk around the block, but keep 6 feet apart from all your neighbors, please.
Will do.
All right, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.